life insurance, I mean, heaven forbid you ever need it,
Yeah.
right? I mean, it's obviously a horrible situation, but I feel like, at least when we had talked, that it really seemed like it takes a horrible situation and just makes it a lot easier to deal with,
That's right.
to be able to give you time with your family, to take care of those that are are left behind.
Yeah.
What was it that you said? Is that you don't need life insurance? What was that?
Your survivors are the ones who need it. You don't.
You're gonna
Welcome back, guys, to another Hey Pops financial video. I'm Mitch, your co-host, and we got Pops here. We're excited
Nice to meet you.
We're excited to have you guys again, and we've got our guest here, Mark Frentress. So Mark and I know each other through our networking group, and he's a life insurance guy. When Mark and I met, I had my perception of a life insurance guy was, and from the movies or whatever, the guy that's needling you all the time to buy life insurance and whole life and term and all this other crap that honestly I still don't even know what it means.
Yeah.
So we're gonna go over all of that. Any questions that you guys might have had about life insurance, why you would need it. Honestly, that's what this video is going to be about. It's going to be super, super informative, and we're going to have a lot of fun along the way. So, Mark, welcome.
Thank you. I appreciate you guys having me. Glad to be
have
here.
you. Glad to have you.
Yeah. So let's just dive right into it. Give us a little history about yourself. So,
Yeah.
how did you come to do this? You've been doing life insurance now for
Since
many years?
2004.
Jeez,
20 years.
20 years.
you're old.
I am. Thank you. I started when I was 3.
Yeah. No, so we talked a little bit about
Yeah.
how you got into it, but for my dad and for our viewers here, tell us how and why. Like,
Yeah.
why was it even of interest to you?
Yeah. So I guess originally I'm from Iowa. So Midwest roots, Midwest values, everything like that. When I originally started a career, I started with a company called Hy-Vee, which is a grocery store chain back in the Midwest.
It's like Kroger.
Yeah, kind of like a Publix, Kroger.
Oh, gotcha, okay.
Anything like that. Aldi at a bigger scale.
Oh, okay, I see.
And I worked for them for 20 plus years, working my way up through the ranks to become store director. And I got to a point where, as my kids were growing up, I started missing some of their functions because, believe it or not, grocery store is kind of a demanding occupation.
Interesting.
Something breaks down, you're the first one that gets called. Somebody doesn't show up, you're the first one to get called. So I was working 90 plus hours and I just had enough of it. And I wanted to get into something where I could help people, make a difference, and have more flexibility in my schedule so that I could be more with my kids.
Mm.
My neighbor on the corner happened to work for a financial service company. And so as I retired from Hy-Vee, we were walking one day and I stopped and I said, "Hey, how do I join what you do?" And that's how it started off. Started my own business back there. We did property casualty, we did investments, we did life insurance, disability. And I really grasped a hold of the life insurance because that's where I felt I can make the biggest difference with people.
Interesting.
And so as we moved out to Arizona, I just kind of followed my path out here and started with New York Life and haven't looked back since.
I love that.
Yeah.
Terrific.
Because honestly,
Terrific.
life insurance, I mean, heaven forbid you ever need it,
Yeah.
right? I mean, it's obviously a horrible situation, but I feel like, at least when we had talked, that it really seemed like it takes a horrible situation and just makes it a lot easier to deal with.
That's right.
To be able to give you time with your family, to take care of those that are left behind.
Yeah.
What was it that you said? Is that you don't need life insurance? What was that?
Your survivors are the ones who need it. You don't.
You're going to be gone.
You're right, because those
right.
are the people you want to take care of.
And
point.
that I think was one of the biggest things that kind of turned me onto it. Another thing, because a lot of people, and I'm sure if you guys have, then put this in the comments, but explain why life insurance through your employer most of the time is not enough.
Yeah. So typically without your going through your employer, my first comment when I talk to any of my clients is take as much as they offer, get as much as you can, because it is very inexpensive. Typically, there's no underwriting that is involved with that. So you can just slide right into the policy.
Oh, great.
No medical exams, that sort of thing.
Nope. Typically,
Oh,
with a
beautiful.
group policy,
Okay.
there really isn't. The thing that it does, though, it is not portable. So if you're with that employer and you leave a job in 2 years, that stays there. And so it doesn't have a whole bunch of portability. It's great, it's inexpensive. I highly recommend getting as much as you want or as you're allowed to, but don't depend on it. Always have a personal policy that you control, and there's nobody who can take it away from you.
That'll go with you. In today's environment, especially, people change jobs so frequently.
Right.
Having another policy that'll go with you, I think, is very important.
Yeah.
Well, we were
as you
just
said.
talking about that, especially
Yeah.
now. I mean,
Yep.
there's so many different opportunities that people don't just stay with a company for 20, 40 years anymore.
That's
Right.
right.
So,
Right.
no, that's I mean, and that I think that's such a great point too. I mean, I know that that's been the case for me, and I've had life insurance with pretty much every company that I've been a part of.
Yeah.
But again,
While you're there.
while I'm there, and that's where it stopped.
Exactly.
Which leads into another question. Obviously, a company provided policy has limitations. Generally, they're not enough coverage, but what's enough coverage?
Right.
If I'm 20 years old and healthy versus 40 or 60 and still healthy, the needs change. So how do you gauge how much insurance is appropriate for someone?
Yeah. So the first thing that I always do, I sit down with the clients, and the first thing we say is, what are you trying to accomplish? Do you want to make sure that the kids go to college? Do you want to make sure that the mortgage gets paid off? Any outstanding debts that are out there. But one of the main pieces that people tend to forget, a lot of households are dual income households.
Right.
So if you take one of those incomes away, their lifestyle is going to change completely.
Dramatically.
And so one of the most important parts is income replacement. So if somebody is making, let's just say 50,000 a year, I always say anywhere from 6 to 10 years of income replacement. So 6 years would be $300,000 just to replace that income. So those are the things that I go through. I go through a personal needs analysis is what I call it. What are you trying to accomplish? How do we get there? Sometimes we don't get there with the first shot, but it's just like anything. As your life changes, as it evolves, you want to always make sure every year you're reviewing it.
You look at it again.
Yeah.
See, and that's something that I wouldn't have I wouldn't have thought that you would need to do. I thought it would just be a set and forget kind of thing. But every year, really?
You
Like,
bet. Life changes. I mean, let's say
interesting.
that I meet with a newly married couple. In 2 years, they may have a kid. They may have bought a house. In 5 years, they could have an additional kid in a bigger house.
Interesting.
So life changes, and you
Right.
want to make sure that you change with that, with all your financial products.
And of course, potentially health issues crop up as you get older too, and it may change year by year.
Yeah. I always say the best time to buy life insurance is today. The second best time is tomorrow. Because you never know what it's going to bring, what health
good
concerns
point.
are going to bring.
Good.
Well, that actually brings up a good question, which is how early should people get life insurance?
Yeah, so a lot of that you have to forecast a little bit. Do you intend on getting married? Do you intend on having kids? Do you intend on owning a home? A lot of people I meet with younger that are 22 to 25, they'll say, well, I don't own a home. I'm not married. I don't have kids. My response to that is that a permanent condition? And they'll kind of look at me and they'll say, what do you mean? And I say, do you always plan on not having kids, not owning a house, not being married? I said, now's a perfect time to get something in place, forecasting what the future is going to bring, and then let it evolve with you.
Don't you typically see, though, those 25-year-olds? I mean, talking about life insurance, that's something that grandpa needs, right? I'm 25, I'm going to live forever.
Right.
When in reality, you're not. But how do you overcome that reluctance?
I think I just sit down and I go through the stages of life. And I put it right into my own because when I was married, we had 3 children at the time. All I had was company owned life insurance, which was $50,000.
Oh
That's all
God.
I had. And I look back on that now, and that scares me because why did I not have more? Nobody talked to me.
You just
Nobody
didn't have the
approached
knowledge
me.
about it.
Yeah. Life insurance was something I never wanted to talk about.
Right.
And so if I am able to get in front of those people, A, they have a little indication that, hey, let's talk about this. So they do, they've already agreed to meet with me. So at that point, I just walk through stages of life.
Okay.
A lot of times they're 6'5" and bulletproof. They're never going to die.
Of course. Great point. I know when I was in the military, and Mitch was also spent some time in the military, we had some life insurance. Do you remember that?
Oh yeah.
Very minimal.
Yeah. Oh yeah.
Very
It's
minimal.
tiny.
But at the time, of course, I'm 25 and bulletproof.
Yeah.
I didn't even consider the need for other insurance, even though I was married, already had a child, and had a second one before I was out. And so those are great things to be thinking about.
Yeah. It's always the last thing on your mind. Nobody wants to think about the end,
Right.
which everybody thinks that's what life insurance is the end. Me, I think it's the beginning.
Interesting.
Planning
What?
stage.
How do you mean?
The planning
Go
stage.
into that.
So I always tell people, you're never planning towards the end. You don't buy a house thinking you're going to pass away tomorrow.
Yeah.
So buy life insurance thinking that's just one more thing off my plate. It's the beginning of adulting is what I call it,
Interesting. Okay, I see.
and move your way forward.
Interesting.
Yeah.
So what does the price point look like, say for a $500,000 policy? Is that something that's gonna break the bank? I mean, how what does that look like?
Yeah. So typically there's no cookie cutter answer for that,
Right.
Mitch.
It changes based off of a number of factors, which we'll get into,
Yeah.
but go ahead.
Typically, I mean, if you're talking a 25-year-old, health condition is very good, you can walk into a $500,000 policy for $15 to $20 a month.
Which is
Wow.
a
Yeah.
couple cups of coffee.
Yeah.
I mean, it's almost it's almost nothing.
That's right.
And that's a term policy, I assume.
That is a term policy.
And hopefully we'll get into term versus whole life and all of those different kinds
Yes,
of.
because I'm still not 100% clear on that, which I'm sure some of you guys aren't either.
Sure.
Right.
But yeah, go. What you were saying though, I'm sorry.
Well, did you want to elaborate on that, or why don't we talk about term versus whole life
Yeah.
and different kinds of insurance policies? Then.
Yeah.
You bet. So I always start with term because that gives you the biggest bang for your buck. You can get the most insurance for the least amount of premium. So the way I describe that, term is like renting an apartment. You move in with your couch. At the end of your lease, you move out with your couch. You don't have any equity in the apartment. There's no value that is built up in that. So that's what a term policy is. You buy it. It's strictly death benefit for X amount of years, typically 20 years to 30 years. At the end of that 20 to 30 years, one thing that everybody thinks is that policy goes away. It does not go away. The premium elevates very expensive. And so the term policy will never go away. It'll become so expensive that typically
doesn't make
people
sense.
will cancel it.
What causes that to go up, just based off how old, health issues that happen, or
Typically age and gender.
And the health issues that come with those typically as
No, once you're locked into that policy, you're into it. Okay, so there's really your initial rating that you got will last as long as that policy will last.
Interesting.
But that term policy, after the end of the, let's just say 20-year policy, you're locked into the premium for 20 years.
okay.
At 21 years, it's going to go up to X amount.
Oh, I see.
22 years, it's going to jump another amount. And it's going to be very, very expensive by the time you get into year 25 or 30 that people cancel them.
Interesting. Which I guess is another thing. I guess why it's important to review it every year to see kind of what you need.
Correct.
So explain to us the other.
Yeah. So the other aspects of it is what I call permanent insurance. And that revolves around whole life. That revolves around universal life. So if you break those down, what whole life, that is like the Cadillac version of life insurance. Let's call it that.
Sure.
So whatever you get locked into for your premium, that will last until age 121. It will never, ever increase.
Okay.
The different aspect of a whole life policy, like with New York Life, we pay dividends. Okay.
Interesting.
So, on top of your guaranteed cash value that builds up within that policy, if you are with a dividend participating company, which New York Life is, you will also get dividends if they announce dividends. And with New York Life, they've announced dividends for 168 straight years. So, chances are pretty good
So
we're going to
so that's
continue
that's
continue.
year after year.
year after year.
Wow.
And when you say dividend, is that something that's actually paid out to you every year, or is it
It rolls.
reinvested and increase your death benefit? Or
That is exactly right, Larry.
Okay.
That goes directly into your cash value that sits there, which pays up additional insurance.
Okay.
So let's say you start with a $500,000
Yeah.
policy, and these are just numbers that I'm just kind of off the top of my head. If you start with 500,000 at year 10, let's just say that $500,000 death benefit has probably grown to 625,000 or so. These are just numbers that I'm throwing out. Within the policy, you could have anywhere from $50,000 to $60,000 worth of cash value within that policy.
Okay.
So that will just continue to grow as the policy matures for you.
Explain what a cash value is.
Yeah. So the way that I always explain cash value is that is the money that is sitting there that is totally accessible to you for whatever use you may seem necessary
Pre-death.
pre-death. So I
Wow.
call that a living benefit
There you go.
is what I call it.
Okay.
A
Heck
lot
yeah.
of people think of life insurance as a death benefit. As you go into the whole life products, there's living benefits that are available, and that's the cash value that you are able to access. So
Interesting.
Via a loan against that policy?
that is exactly right, Larry. You
Okay.
never ever want to withdraw the money. You want to take a loan against that policy.
Then you just pay payments per month kind of thing.
Yeah, let's talk about that a little
Yeah,
bit,
please.
Mitch. So, as you take a loan, that rate is going to be variable. Right now, I think it's right at about a 5.3% loan.
Okay.
You are still going to get paid your guaranteed cash value and your dividends from that policy, even though, let's say you've taken $10,000 out, you still get paid that on those. So if
Okay.
you have an internal rate of return of a policy of let's just throw out 4.5%, could be higher, could be a little lower, but for ease of math, let's use that.
Yeah.
You're still going to get paid an internal rate of return of 4.5%. You have an outstanding loan that they're charging you, let's just say 5%. Once again, ease of math for Mark. So in essence, you have a 0.5% loan that you're able to access. So you're still getting paid that money,
Oh,
even though you have that out, if that makes sense.
interesting.
Now, I would assume that 0.5% or whatever that figure ends up being, that that you are in deficit to your because of the loan, would be recouped by the dividends, by the internal growth of the policy, et cetera. It's not like you having to write a check every month
Yeah.
to New York Life or whoever it is. Is that right?
Let's go over that a little bit.
Okay.
So you do not have to pay back the loan if you do not want to. I always tell
Oh,
people
interesting.
chip away at it, but the main thing you want to make sure you always do is pay back the interest. Keep up on that interest. Every month you're going to get a statement saying, "Hey Mitch, you owe X amount of dollars towards interest on this loan that you have outstanding." Pay the interest. Keep on top of that so that
Okay.
loan doesn't grow on you. Just like a credit card, if you would think of it that way a little bit.
Okay.
If that loan is not paid off when your day comes, they will take that off of the death benefit.
Oh, great.
So let's just say that once again, we've got that $500,000 policy. Mitch has lived till age 90. That $500,000 has now grown to 1.2 million. He didn't pay back the 10,000 bucks. $10,000 is going to come off that death benefit at the end.
Which at that point is minimal.
Yeah,
Because you kept up on the interest payments, not the principal of the loan.
correct.
So my question is, how does it grow?
Uh-huh.
Because you've mentioned that a couple of times. How does the value go from, say, 500,000 where you start to that 1.5 million?
Yeah.
How does that work?
So as you have your guaranteed cash value and you also have your dividends, I would say probably 90% of the people use what's called paid up additions. So what those funds do is they float over to your death benefit, they increase your cash value, and it also increases the death benefit. So every year as you're paying that, dividends go up, cash value goes up, death benefit goes up.
So you mentioned that New York Life will also invest the money that you're paying in every month?
Yeah.
Or what is it that they end up investing?
That's how they pay the dividends.
Oh,
The
I see.
profitability of the company is how they declare their dividends every year, which is coming up within the next couple of weeks here. But that's how they are able to continue to pay the dividends when declared and also keep up on the cash value that they're
Awesome.
promising.
There we go. That's where those dividends come from.
Yeah.
What is their typical dividend? And are they pretty well in line with the market, or are they high, or are they low?
Yeah. So it's a very, very complicated figure that they use for the dividends.
Mm-hmm.
I can tell you that typically with all mutual companies, New York Life is number one, number two.
Okay.
We're an A++ rated company, very, very sound, very, very secure. All insurance companies are required by law to have what's called a surplus. So somebody says, well, what happens to my policy if New York Life goes under? Every policy we sell, we are legally obligated to have a surplus. If something happens, that surplus makes
Covers that.
our clients whole.
Oh, interesting.
Yeah.
So you get life insurance and you're okay. You're going to be okay
Correct.
no matter what happens to the provider.
Correct.
That's really important to know
Yeah.
because just thinking of my own, like I'm pretty risk averse. And so that's a huge comfort to me.
Yeah.
To just, heaven forbid something happen. That's great to know.
A lot of times people say, well, why don't I just go out on the internet? Why don't I call 1-800? Why don't I do this? My response is, I have no problem with you doing that. My concern is, will it be there when you need it?
Right.
With a company like New York Life, been around for 178 years,
Great track record.
it's going to be there.
Yeah.
Good
Plus,
point.
you get somebody like me.
How can you resist
That's
that?
right. Not somebody on the end of a phone call.
Who can't even speak English?
That's
Let me divert a little bit to a couple of other questions. You mentioned universal life.
Yep.
As opposed to whole life. What are the differences?
So once again, whole life, you have the guaranteed cash value, you have the dividends, you have the increasing death benefit, you have the locked in premiums. Universal life adds a little bit of flexibility. Cash value doesn't grow as fast, does not get paid dividends. So if you think about a universal life policy, your premium, let's just say, starts at $1,000 a year. As you celebrate birthdays, cost of insurance is going to go up.
Mm-hmm.
So as you get into your older years, if you have not funded that policy correctly, they're going to come to you and say, hey, in order to keep this policy running as it has before, your $1,000 a year now needs to be $1,500 a year.
Okay.
The following year could be a little bit more. And there's some flexibility within universal life. Let's say that you're a business owner and things are a little tough and you're not able to make that premium payment that month. You're able to skip that, make it up the following months.
Okay.
You still have to pay it, but it allows that flexibility. Where whole life is pretty locked in. You have to make the premium payments. There's flexibility as to how many years. You can say, I only want to pay on it for 5 years. I want to pay on it for 10 years. You can adjust it however you want, but the premium will reflect that as you put together that policy.
So there are mechanisms in place then to only pay for a certain number of years, and after that you still have the death benefit, but you no longer have to pay anything into it?
That is correct.
Is that with whole life and universal, or?
I always say it's more towards the whole life, because
Okay.
universal life, you might be able to skip premiums for a while, and then
Pick it back up.
then you might have to pick it back up. With a whole life policy, if you have been paying premiums and you do what's called a 10 pay, which would be a 10-year,
Mm-hmm.
at the end of that 10 years, you are done. And
Okay.
it's going to continue to grow cash value. It's going to continue to grow your death benefit.
Tell me about the, because I've had several different life policies over my career. Tell me about the fees associated with it and how much that impacts, me on my end, not only with the cash value, with the potential death benefit, et cetera,
Mm-hmm.
and how different are those fees company to company?
Yep. So no fees with New York Life. Everything that is a fee is wrapped up within your premium.
Oh,
You
interesting.
will never see another, hey, Larry, you owe us $4 a month for a management fee or administrative
Oh.
fee. You'll never see that. There are no fees in that. All the pricing that has been developed is in the premium that is set. When you get into, and I don't want to get too far in the weeds with this,
Sure.
but as you get into a variable universal life, that's where some fees are going to be associated depending on where you have your money invested with the variable.
Another question that I thought earlier when we were talking about different kinds of policies. I know you can take out, if you've got a mortgage on a home, you can take out mortgage insurance or something that would pay off your mortgage should you expire. What's the advantage or disadvantage of that versus having enough life insurance in a policy that you're talking about to cover that eventuality?
Oh, interesting. So you're
Yeah.
saying the difference between having mortgage insurance or just having life insurance to just
Enough to pay the
Yeah.
mortgage
oh,
if you died.
if you
Yeah.
okay.
So yeah, very, very good point. I'm glad you brought that up, because there's also car gap insurance, things like that, to
Yeah.
make sure your loans get paid off.
Right.
9 times out of 10, taking an individual policy out, you're going to be better off, because the companies that
By
offer,
individual, you mean, like a New
You
York Life
own it.
policy or
You
something like
bet.
that.
Oh,
Okay.
gotcha.
you
Okay.
own
As
it.
opposed to two separate policies that
Yeah.
one for my mortgage and one for my life, whatever.
Yeah, because mortgage insurance, basically, once again, if you go back to our conversation on a group life policy, you own it, but you don't own it, if
Okay.
that makes sense.
Mm-hmm.
With mortgage insurance, you pass away, your beneficiaries don't own it. They're just going to automatically pay off the house.
Okay.
Okay. If we take that into consideration as I sit down and I do my financial analysis with you, hey, Mark, I want to make sure this $300,000 mortgage is paid off. We figure that into the life insurance. Your beneficiary can decide, do I want to do that, or do I want to use those funds for something else? For
Interesting.
mortgage insurance,
You have no
it
choice.
is set in stone.
Oh, see, and that makes a lot more. I mean, for me, just speaking personally, I would prefer
The flexibility.
the flexibility
Yeah.
there.
Plus pricing on premium, you're better off with an individual policy. Premiums are going to be a little bit less than a mortgage insurance,
For the same amount of coverage you're
if
talking about.
not more. Yeah.
Okay.
Awesome. So
Great.
just to kind of, I mean, this honestly has been just awesome. We're kind of getting to the close to the end of our time, but as we're kind of wrapping this up, what are some other things that you would say you should consider when you're looking at life insurance?
Yeah. So one thing we didn't really touch on is the tax advantage of life insurance.
Right.
If you have once again, a $500,000 policy, and your day comes when you pass away, I will deliver a $500,000 check tax-free to that beneficiary. So
Interesting.
things within life insurance are tax-free. You do not have to claim it as income. You will not get taxed on it.
See, I didn't realize that.
Yep. And so that 500,000 will go directly into your beneficiary's pockets. No taxes on that.
That was what leads into one of my questions too as we wrap up. I've heard people talking about life insurance as an investment tool, as opposed to a protection death benefit kind of tool. I know when my folks passed away a few years ago, they had a small policy, and it paid for the funeral and all the expenses associated with their passing. And each of the kids got a relatively small check out of it, which was nice to not have to at least pay out of our pocket for their demise. But that's completely different than, oh, I've got, $500,000 or $1 million that I want to provide some kind of legacy for my children that they can take tax-free. There's a very different reason behind investing. I would assume that changes the product that you would sell me, the amount that you would sell me. All of the parameters would change based on what I'm looking for out of that policy.
Right.
Am I right?
Yeah. So let's touch on that real quick. One of the key things that you said was investment vehicle. I want to be very, very careful when we talk about that. Ultimately, first and primary, it is life insurance.
Okay.
Right.
Okay. That is our primary goal that we're going to put together this policy for. There has been kind of a wave because of the tax benefits that are out there that people are what's called overfunding policies to help supplement their retirement. Because once again, going back to the previous comment that I made, everything when properly structured within life insurance is tax-free. So as you withdraw that money, that's your money. It's tax-free for you.
Interesting.
You will not have to pay tax on it. That's where you want to make sure that you're dealing with somebody who knows what they're doing. Those things can go south in a quick way if they are not structured properly. But yes, there are great ways to help supplement your income, help supplement retirement, and help maybe if you're trying to debate, hey, when do I take Social Security? Do I take it at age 62, 65, 67? Well, the cash value in your life insurance can help bridge that a little bit to get you to that stage where you feel I'm going to max that out.
You can maximize that benefit.
Correct.
Good point. Thank you.
Yeah.
There you go. Awesome. Honestly, Mark, it's been super awesome. I hope you had a good time. And guys, if you've gained value from this, please hit a like, subscribe, share it, do all those awesome things. If we want, if they want to get a hold of you, how do people reach you?
Yeah, they can. I have a website that's out there, mark@mfrentress.com. We can probably put that somewhere.
Yeah, we'll put a link
comments.
in the description there. So
Or even phone 480-848-1783. Can get a hold of me.
there you go. So now you got, all sorts of weirdos that are gonna
That's right.
reach out to you. Not to say that any of you guys are weirdos, but
Maybe they're reaching out to the weirdo. I don't know.
Yeah, that's true. That's true. We do appreciate you, and we'd love at some point down the road to get into this a little deeper.
Yeah.
As our listeners have comments and questions about their particular situations and how those apply. So
Yeah.
we would love to talk with you further as we have time. So
That would be fantastic.
thank you for your time today. We really
Thanks for
do
inviting
thank
me.
you.
and thanks for joining us. And again, those questions that Pops is talking about, just make sure that you put them in the comments so that we know what to talk to Mark about here the next time we have him on. We'll see you guys later.
Thank you.